All right, right off the bat, two questions. Number one, what happened to this cat behind me? And number two, what's been happening with Groupon stock recently? I want to answer the latter question in detail, so let's get started. Hey everybody, Tom Gentile. Welcome to Tom's Trading Room. Glad to have you here. In this video, I want to discuss Groupon, the stock, what's been happening to it recently, and what kind of opportunities do I see as a trader. Okay, before we get into technical analysis and fundamental analysis and news, let's just talk about Groupon for a minute. So the company was founded and got its start back in 2008. The very first deal they ever did was a 2-for-1 pizza deal with a motel in Chicago. The concept grew and grew so much, they realized they had caught some fire here. They went public on November 4th, 2011, and the company just seemed to have no end in sight. It was an absolute great concept, taking the coupon idea and bringing it to the internet. There you go, ergo Groupon, the company itself. The problem? Well, the idea was so great, everybody started doing it. All right, you got social media companies, Facebook, Amazon, even merchants like MasterCard, Visa, American Express. Everybody got into the game of offering internet deals and internet coupons. And while Groupon was, I believe, the pioneer, it ended up really hurting them in the end because they really didn't have a way of holding on to that customer base. All right, so let me show you a chart of this company and you'll see what I mean. Now, take a look at this chart right here behind me. Groupon went public on November 4, 2011 at 28. So why is the stock trading at $622.80 on IPO day? That's probably the most important question. And then do you see this move to the downside here? Yeah, that's what happens when you have too much competition out there and no real idea of what you're going to do as a company going forward. The reason that Groupon was repriced at $622 a share is something called a reverse split. Now, most of you out there know what common splits are, and let me tell you what they are. They're when the price of a stock gets dropped in price, but then there are more shares offered. So, for instance, a 2-for-1 split. If you had XYZ at 100, and you had 10 shares of XYZ at 100, and a 2-for-1 stock split came your way, then your XYZ stock, you'd then get 10 more shares. So now you'd have double the shares from 10 to 20, but the stock price would get cut in half at the same time. You don't really have anything of more value, but the biggest reason companies go out and do stock splits is because it lowers the price and allows smaller investors to get involved with the company. And the idea is that if more investors get involved, the price will gradually rise again. But what is a reverse split? Well, it's actually the opposite. A reverse stock split is when shares are actually taken out from the outstanding number. If you have 100 shares of XYZ and it goes down to a price where a reverse split takes place, you might get 90 of those shares taken away, but the price goes up 10 times as much. Again, less shares out there to buy and sell, but at a higher price. Reverse stock splits will occur as 1-to-5s. That's where for every 5 shares that you have, you're only going to have 1. They're going to take 4 away from you. Same thing with a 1-to-10. The market caps are not affected. Here's what's been going on with Groupon. So recently, Groupon had a 1-to-20, all right, 1-to-20 reverse split. The stock went from around $1 a share to $20 a share at the time that happened. In fact, the only people who really got upset about this around the day of the stock split were day traders, because day traders love to trade stocks that are trading around $1. But when that dollar stock jumps to a $20 stock, they don't like it so much anymore. All right, so a reverse split. Just a few things I want to mention. First, it slows down the potential of delisting the company, and that's possibly what could have happened here. The fundamentals of the company still remain. And here's the problem with reverse splits. I find it as an opportunity. It's typically a selling opportunity, because if the stock gets repriced higher it tends to drift back down once again. Take a look at a lot of the reverse splits in the past, and you'll see that is the case. So this actually creates an opportunity for folks who are bearish on Groupon. Again, look at the news that's going on out here. Groupon rises after earnings, after revenue plunging. All right, why is Groupon stock falling again? Will they break the reverse split case? And then here's a real important one right here. Groupon is, there's a company that's out there that is trying to bring a lawsuit to them for investors who suffered losses exceeding $50,000. All right, so all of this is negative news for the company. Now, let's take a look at some of my charts. First one I want to show you is this is a chart of Groupon, and I've got a big support area down here around $10. Here's another chart I want to show you. This is a chart of different trends, all right, different channels. The long-term channel for Groupon is definitely down. All right, we do have a medium-term channel, which is sideways, and a short-term channel that is up. But there's a lot of consolidation that is happening just around the $30 mark, all right, just below the $30 mark, which could put more pressure on this stock to go lower. And finally, this is the one I think is the most important, the probability cones. Probability cones take a look at statistical volatility, basically what the stock has done in the past. And through this, we're able to get an idea statistically of where this stock is likely to go, and more importantly, where it's likely to hold. Now, because of option prices, this shows the 95% statistical high on Groupon could get as high as 60. But if you look at everything that's happened to the stock from the day it IPO'd, more than likely it's going to head down to the lower end of the probability cone, which guess what, is trading at 10. Now, what can we do with this? Well, we can short the stock at $20 or higher. All right. Problem with that is that comes with risk. There's risk that it could go up to the $60 range and we could be out a lot of money. All right. The cost of shorting stock can exceed a lot of folks' accounts. All right. The break even on shorting a stock is basically wherever you short that stock price at. And the big question is, are there any alternatives? And of course there are alternatives if you are an option trader. Let me show you one such alternative. This is called a bear put spread, or what we call buying put spreads. We're buying a higher strike put and selling a lower strike put. The cost and risk is lower than the outright purchase, and your reward is limited to the stock going down to the lower strike price by expiration. All right? But since this stock could go no lower than zero, shorting the stock has its own limitations. Now, let's take a look at a graph here, and this is a graph of Groupon, and you can see here what I'm looking at is I'm looking at the July 24th, 2015 put spread. All right, the 20 puts are trading just above 3. The 15 puts are trading for about $1.20. So we don't need Groupon to go down to 10 to maximize this trade. If it just simply goes down to 15, we get our maximum reward. All right, so maximum reward on this, if we were to put this whole trade together, we're talking about a trade that's going to end up costing not $3.05, all right, but when we back out the $1.20, we're talking about a trade that's going to cost somewhere around $1.85, all right? So with $1.85 risk, that's $185 per contract, all right? So how do we determine what our reward is? If you take 5, all right, that's the difference between 20 and 15, 5 points. Back out $1.85, and what you're looking at is a potential reward of $315 per spread. So risk, 185, reward, 315. You can see it here on the graph. If we go above 20 and we keep on going and it goes to 60, the most we can lose is $1.85. But if the stock does go down to our expectations at 15 or below, we could maximize this and bring in a trade that has nearly 200% reward to risk ratio. In summary, Groupon's reverse split is like most others. It's typically a negative. The other thing is that fundamentals and the technicals of this company are negative too, and every strategy that I showed you, well, you have to have the belief that Groupon is going to head lower if you would want to enact a strategy like this. All right, hey, thanks for joining me. Once again, hit that like button if you like this video, and if you subscribe, I'll get all my videos to you as soon as they're uploaded. Have a great day. We'll see you soon. Bye now.